Welcome to the AAMA Mid-Quarter Market Commentary. I'm Bob Baker, President of AAMA, and joining me today is Phil Volker, AAMA's Chief Investment Officer. Hey, Phil.
Good afternoon.
How are you today?
Good.
Super. As many as you know, AAMA is a registered investment advisor located in Columbus, Ohio. We manage just a little bit less than $1 billion in assets under management and advisement, and we maintain and provide a series of portfolio model solutions to investors. And today we'd like to provide our mid-quarter market commentary. Today, post-election, we've seen a number of new market highs or close to market highs. Stocks are almost at all-time highs. Home prices are at all-time highs. Gold's at an all-time high. Bitcoin is at an all-time high. The national debt is at an all-time high. National spending is at an all-time high. And we've lived through core CPI inflation that's been greater than 3% for 41 straight months, which I think is the longest period of time since the early 1990s. So we've got a lot of things to talk about, so I guess we better get moving ahead. Phil, could you take a couple minutes and talk about the Federal Reserve, some of their comments, some of their actions, and inflation?
Sure, we could spend hours, obviously, on the Federal Reserve and their history. But if we focus on the last couple years, 2.5 years actually, since they started increasing rates, the inflation rate headline has come down, certainly, and a lot of that's because of goods prices that had been high during the pandemic, because of the pandemic. But we also have services that have been sort of sticky. And I think it's interesting, if we look at the PCE inflation for a second, I've got a chart here that's the last 2.5 years since the Fed started increasing rates. The blue line is the super core PCE, and the gray line is the services component. And the arrow at the bottom is exactly at the end of last year, when you may recall the market had priced in and fully expected 8 rate cuts to occur this year. That was right in front of almost a 2% acceleration in the core and services segment of the PCE. These are 3-month moving averages, so to smooth it out a little bit. And that sort of dashed the hopes for rate cuts. Those numbers subsequently came down, and we started getting rate cuts, a couple months ago. But it's also interesting, if you look in the last, in the circled area, the last couple months, those numbers have started to increase. They're not accelerating like they did earlier in the year, but they're both up about 50 basis points in the last 2 months. So I think we could say that we're sort of in limbo right now. In fact, the Fed has, in the last week, come out and sort of telegraphed their intention to maybe reconsider further rate cuts this year. They haven't said why, but they are certainly changing their tune to being a little bit more hawkish than they had been previously. And it's interesting, I think, also, that if we look at the second chart, this is a chart of the 2-year, 10-year, and 30-year mortgage rates. The two lines that follow very closely, the bottom of the chart, is the 2-year and the 10-year. And that arrow is the day of the Fed first rate cut, the 50 basis point cut. And we always say that the bond market is one of the smartest indicators around. And you'll see that 2 and 10-year rates are up 0.75 of a percent since they cut rates. And mortgage rates are up 60 basis points. So the market is saying that the Fed probably went a little bit too early, too fast, or maybe a little bit of both. So it's problematic, I think, to say that the Fed is on a clear course to dropping rates further. There's a few more key data points to be reported before the next meeting in December, and them being data dependent, those will be important. But the trends in the last couple months since they started cutting rates are not in their favor for continuing rate cuts.
Could you take a couple minutes and explain to our listeners why we believe the bond market's a pretty good indicator of what's going on in the world?
Well, the longer rates, the 10-year in particular, is probably the most watched rate in the world, discounts 10 years of inflation and economic growth. So, and the Fed does not control that. They control the overnight, the short-term rates. So the 2-year is an indication of what the market expects the average short-term rate to be over the next 2 years. And the 10-year starts pricing in a longer-term inflation expectation and a higher risk premium. But it's independent of what the Fed does, and it's a representation of investors around the world as to the expectation for future inflation.
And do you think some of the movement in the long end is in anticipation that the Fed's going, or the U.S. government's going to have to refinance a lot of short-term obligations they've issued over the course of the last 2 and 3 years, and they're going to probably have to roll into a substantially higher short-term rate or a not much more of a marginally higher 10-year rate?
Well, certainly the amount of debt that is coming due is significant. And if we continue at $1.5 to $2 trillion of deficit each year, that simply adds to it. But yes, the Treasury's been financing a lot of their debt in shorter term maturities. So there's a bigger wall of maturities coming up that, depending upon their conclusion and the Financing Advisory Board conclusion, will determine how much gets sold or offered in the longer rates versus short rates. But bottom line is there's a lot of debt to finance over the next 12 months.
Absolutely. Let's shift gears for a minute and talk about the stock market. The highs are close to new highs, PE levels, and the process we go through fundamentally to kind of help cut all the noise out of the market and out of our mind and thinking, so we can focus pretty much on the fundamentally designed discipline that we've been following for over 20 years.
Sure. I will throw up one more chart, and that's the forward PE ratio. And it's currently at 22, which is where we spent a lot of time in 20 and 21 before the 20 plus bear market that we had in 2022. It's a high reading. There are other measurements that one can look at, trailing PEs, total market value to gross value added. Any measurement you want to use shows currently an overpriced stock market. The bullish reaction to that is, well, the market is anticipating good earnings, and earnings can grow into it. So it's interesting that earnings just now, meaning the second quarter of this year, just now exceeded the peak that they reached 2.5 years ago. So it's been 2.5 years since we've seen a new high in corporate earnings, and that's based upon the S&P 500 operating earnings. So we had a mini earnings recession. We've recovered from it, and the market is expecting great things going forward with numbers of 15 to 20% year over year earnings growth starting in the fourth quarter of this year and through next year. So there's a lot of optimism about earnings growth. That's one of the reasons the market is at these levels. But we like to see proof of those numbers developing over time, because typically they decline. Those numbers, were several points higher just as recently as 3 months ago. So the expectations tend to come down over time. And obviously time will tell, but for right now, what we say is that the market is in a high risk area. That does not foretell a bear market. It just means that negative news can have a larger impact on stock prices than you would if you were at 13 or 15 times or even 17 times. So, that makes the stock investing a little bit more fraught with danger, if you will, but that's where our sector allocations come into play. And even though healthcare has been underperforming here since the election, healthcare still represents one of the better values or relative values, with 33% earnings growth projected over the next 12 months and trading a slight discount to the market PE. A lot of the weakness recently has been in the drug stocks, but healthcare remains one of the more attractive sectors, and certainly price volatility and earnings volatility are less than the market.
And it's kind of interesting that there's really only, two sectors that are in the 66th percentile of where they've been historically, and that's telecom and energy. And then healthcare is just a little bit above that. But all the other sectors are in the high 70s to 80s. And I can't remember a period of time too recently that's all the sectors have been so overvalued. Any thoughts on that?
Well, it was the case, as I recall, back in late 2021, as the market was making highs. I don't have it in front of me, but I believe that they were all significantly overvalued at that time.
Mm-hmm. Mm-hmm. And we kind of talked about the government spending and money supply a little bit. Anything you want to add there?
Well, money supply growth actually went negative several or a couple quarters ago, and has now turned positive. Cumulatively since the pandemic, it's been growing at 6 to 7% rate, considering the down and the up move. So it still has a fairly high growth rate, and it circles back to the Fed's dilemma with their balance sheet still being quite large. And so they're fighting with their mandate, but also fighting to reduce the amount of liquidity in the system, meaning their balance sheet, money supply, without disrupting the economy to a large degree. So it's a tricky walk.
Yeah, it really is. And anything else you'd like to add before we close today?
Well, I think as we've repeated for years now, or at least 2 years, there's been just about every economic indicator that predicts recessions has ticked off a recession, be it the yield curve, leading lagging indicators, ratios, you name it. All of these indicators have had 100% success in predicting a recession, and has not happened. And we've been pretty consistently saying that we did not expect a recession, uh, despite these indicators. This last summer, we did open the possibility for that position to change sometime next year. And one of the reasons for that is the cumulative effect of the inflation we've had on the economy and also the housing market. The housing market has been stuck in the doldrums, and the increase in mortgage rates back to close to 7% is not going to help unlock the real estate market. Sales have been way down. People with low mortgage rates don't want to sell, and a lot of people have been priced out of the market from and just can't afford or qualify for buying a larger house or buying their first house because prices are up so much and interest rates are relatively high. So it's interesting that the phrase soft landing is no longer commonplace in the financial media, but I think it's still an objective of the Fed to engineer a quote soft landing. So far, they've avoided any landing whatsoever, be it a hard landing or a soft landing. But the prospects for a slowdown in the economy are building sometime into next year. But who knows? We could continue to be surprised with the strength of the economy.
Oh, yeah. And when you look at mortgage rates and home prices and monthly payments, you figure 2 or 3 years ago, you could borrow money at 2.5 to 3.5% long term. And today you're looking at close to 7. So that same monthly payment is almost doubled for the same house. And most real estate taxes are a lot higher than 3 years ago too. So it's really having an impact on the whole housing market. So,
Yep.
well, mhm.
Yeah. And not to mention insurance premiums as well have gone up significantly. So
That's right. Well, we'd like to thank our listeners today for taking the time to listen to some of our comments and thoughts on the markets. As I mentioned earlier, there's always a lot of noise in the marketplace, and our fundamental valuation process we've designed and deployed for over 20 years is designed to focus really on the fundamental valuations of the market and cut out that noise. So we are always attempting to stay rooted in our disciplined investment strategy. So we'd like to thank everyone for listening today. This will be our last commentary until after the first of the year. So happy holidays, and we will see you after the first of the year. Thanks.